Good morning, everybody. Bruce Robbie, CEO here at Relevant Wealth, checking in. Just back from the Exponent Philanthropy Conference, which was super exciting in beautiful Columbus, Ohio. About 400 of us got together. And if you were there, you know what a great event it was. And one of my presentations I had on Wednesday morning was talking about different ways for foundations to manage their investments. We had a great turnout, but also I know some of you would love to have participated, so I've created a virtual recap of that presentation to share with anybody that wasn't able to sit in person. So let's dive in. The title of this presentation, Who's Driving Your Portfolio? 4 Investment Management Approaches for Foundations to Consider. And I'll be happy to share any of these slides afterwards. The goals of the conference were, there's a bunch of goals. It was a great conference, lots of learning going on there. And so everybody took away, all kinds of different things. We made a lot of friends. We learned from each other. We hosted a great dinner one night, and networking was a lot of fun. But it's always good to have really valuable content. And so I asked the group, why are you here today? And many of them, are concerned about the investment landscape and how to position their foundation's assets appropriately with a battle-tested process. And so that was the core of my presentation. Myself, I'm here because, in October 1989, I was at the time a civil engineer designing and building bridges for Caltrans. And we had this terrible earthquake on October 17th, 1989 in San Francisco. I came to San Francisco along with many engineers to assess the damage to the freeways, demolish freeways like the Cypress Freeway, and rebuild the Bay Area. And I spent a few years doing that, and I realized at the time I was really curious about financial services, and so I ended up going to graduate school at night, studied financial services, and then in 1991, I transitioned into the wealth management space. So this earthquake really shook up my life, so to speak, and set me in a new direction, and one I've been very lucky and fortunate to enjoy. And so that's my story. Let's go. So let's jump right in with this presentation. And as I said, we did poll the audience, and many people are concerned about investing going forward. Of course, investing the last decade has been really quite amazing. The stock market has been on fire. Most asset classes have done quite well. And also, there's some ambiguity around how much people really understand what's going on. And working with a professional, it's important that they make sure that you are along for the ride in that journey. And then we talked about, well, how often should you meet? Generally, we like to have 4 investment committee meetings per year at least, and then a lot of information in between. And the average foundation in the room was meeting 2 to 4 times per year. So the agenda today, let me just zoom out. We're going to talk about the importance of the investment policy statement, the role of asset allocation. We will talk about these 4 common investment management models, and then I'll have some steps to help you create your own roadmap so you can have a sound long-term investment strategy. If you have any questions, please reach out to me directly. My contact information is at the end. So the key takeaways today, you're going to, after the end of this presentation, you're going to understand your fiduciary role, which is essential to deciding how to work with other experts. And you're going to master the building blocks that go into a solid investment policy and an investment strategy, because if you don't understand the building blocks, well, how can you really identify which of the 4 models make sense for you? And then once we talk about the 4 models, I'll give you some tips as to how you can decide what model's the best fit for your organization. So let's just dive right in here. And first things first, knowing the rules is so important as we think about our fiduciary duties and trying to make great decisions for our foundations. And fiduciary duties have kind of three key things you need to do. I'm a fiduciary. If you're on an investment committee or board, you have a fiduciary duty to your foundation. And as it relates to investing, 3 things you have to do. First, you have to approve investment policies. That's these are table stakes. You have to employ appropriate asset management. We're not sure what that means. And we need to review investment performance. Now, we do not have to be an investment expert. We just need to do these three things. And certainly we should use experts if we're not an expert. Now, it's getting a little more complicated, of course, because the landscape's changing, and now particularly with alternatives, we have so many opportunities in the alternative space. Many are really confusing. Some require big time commitments. We have impact investing and ESG investing. There's a lot of variety, which is terrific. But if you don't understand the nuance of these, maybe it's hard to understand how they might be appropriate or inappropriate for your portfolio. Also, kind of governing private foundations is the Uniform Prudent Management of Institutional Funds Act, MIFA. And the key elements here, the duty of loyalty, care, and obedience. You got to have written investment policies, and that's written. You have to have prudent management of the investments. You are required to diversify your investments. Now, maybe you didn't know this, but because we are managing money that technically belongs to the public now, we are responsible for having a diversified strategy, a little less risk than we might take ourselves. And we are also required to do financial reporting. We're supposed to track our progress and understand. If you get these slides, there's a great link here with more details about MIFA. And so if you want the slides, just let me know and you can use that link. So why should we have an investment policy statement? It's a great question. I love this guy asking that question. I want you to think of the IPS as your foundation's roadmap. And during the presentation, I tried to make this a little interesting so we could hit on key points and have some learning along the way. The first question, you really need to decide who's going to be on your bus. So as you think about your investment policy, who are the people, investment committee, board members, other professionals that are going to participate in the process? It could be the entire board. If you have a smaller foundation, that's not uncommon. Larger foundations also often have investment committees. Likely you're going to have investment professionals, financial advisors. You might have a chief investment officer you hire, accountants, bookkeepers. And so, identifying who's going to be on the bus is really the first step. The next question is, where are we going? So the IPS is your roadmap to ensure that your foundation and your manager or managers are all aligned with the investment goals and strategy. So this written document spells out who's going to do what and when and who's going to be responsible for different activities. And some of those activities and some of the decisions we have to make, asset allocation, very important. It's the most important decision, frankly, in the IPS. That is how we decide how we're going to divide our endowment between different asset classes like U.S. equities and fixed income securities, international equities, alternatives, cash, etc. So that is defined in the investment policy statement, usually set by the board or the investment committee, and it usually stays intact for a long time. We want to understand our risk tolerance. How risky of a portfolio do we want to have? Asset allocation is part of that answer. The next part is the specific investments. Do we need liquidity for grant making? What are the goals, the return goals? And the IPS should have some sort of guidance on what we're expecting to return so we can have a budget. Also, we can measure our actual performance against those goals. Having a timeline, understanding if there's any investment constraints. Maybe your foundation has a passion for impact investing or ESG investing or other limitations. And then as we talked about who's on your bus, roles and responsibilities. Those are all elements of a comprehensive IPS. So how are we going to get there? And I talked about the importance of the asset allocation. So that's the how are we going to get there part. How are we going to divide our assets between different asset classes and then different investments? We might have a high-risk strategy for some of our investments, certainly not all. We might have a low-risk strategy for part of the portfolio, and we might have average risk strategies also. And it's just fine to have a range of investments that do different things. In fact, that is the goal of diversification. And this chart, let me just zoom in here. You can see just an example of different asset classes or sub-asset classes. Cash typically the lowest risk, lowest return asset class, and then we have bonds and real estate and equities, et cetera, and private loans and private equity. So we have so many opportunities here. It's tremendous, and each one of these has a risk and return profile. One is not better than the other. They're all great. They're just different. And so understanding that we can have different elements of these gives us opportunities. It's also a lot to think about. So that's part of the challenge, and that's why we want to work with professionals at the end of the day. So how do we decide? How are we going to decide what asset classes make the most sense? It's a great question. Or we can ask for directions. This is being done by many, many foundations, and long-term history of what asset classes do, and we have a lot of information. So Exponent Philanthropy, actually, let me zoom in here, has a survey they do every year. This is the results from their operations survey, and it shows you what the average Exponent foundation is doing with their investments, with about 50% in domestic equities, 19% fixed income, some international investments, alternatives, cash, other. So this is one metric we could use as a starting point. Council on Foundations also has a very comprehensive study they do every year. On the right here, you can see I've circled foundations with under $100 million in assets. And a survey, they had 61 foundations, which is a pretty good sample size. And this is how they're invested: 38% equities, 17% fixed income, 17% non-equity, 24% alternatives, et cetera. So those are valuable. We can also talk to experts and see what they recommend based on our specific situation. So once we have that asset allocation set, I can't emphasize the importance of staying on course. And what's the benefit of that? Well, just imagine having a crystal. Wouldn't it be great to have a crystal ball where we know what all the investments are going to do for the next few years, and then we just dial that in and step back and focus on our philanthropy and our grant making? Well, we don't have a crystal ball, unfortunately. We know that, but we have something that's kind of similar. And it's called periodic rebalancing. Now, that's not very sexy sounding, but it's a powerful tool you or your professionals can use to take advantage of the volatility we know is with part of all of these assets. We know markets go up and down somewhat randomly, frankly, or unexpectedly. And so rebalancing is a way to take advantage of that to your benefit. So let's just say you have a 50% allocation to U.S. equities, and the stock market drops, and then that shrinks down to 45%. Well, in that case, we'll take that 45% and we're going to add to it and bring it back up to 50%, back to our target. So we're going to buy low and then rebalance back up to 50%. Now, let's say the stock market keeps growing like it has for the last decade, and that 50% creeps up to 55%, well, now we're overexposed to U.S. equities. We're going to sell high. We're going to reduce those equities back to 50%, redeploy that money in the other asset classes that are underweight. And by doing this kind of buy low, sell high rebalancing, we don't have to guess where the markets are going to go. We can just take advantage of the inherent volatility that is part of the investing experience. So keeping score is super important. Tracking your performance is actually pretty challenging. You got to have sophisticated software to calculate accurate performance. You have to have every dollar in and out of the account. You have to have the value of every single investment every day. You have to track that over time, and it's not easy to do unless you have a comprehensive portfolio management system, which a good investment advisor consultant will have. So keeping score is important. There's a couple ways to do it. You can look at the total performance, of course, that's important. We can look at asset class performance relative to one another and expectations. We can look at the goals of the investment policy statement. We can benchmark performance, and that's important, where we look at maybe a benchmark of indexes or other foundations and compare how we're doing. And this gives us, some valuable information. It's not like good news, bad news necessarily, but it's, what's working, what's not working. what should we be taking a look at, what is not meeting our expectations, and how do we make adjustments. So tracking results is super important. Okay, just a few other suggestions I had at the conference. Turn off the financial news. Now might be obvious to most of us, but the financial news is selling products, right? This is entertainment, and they do weave in a bunch of advice. That advice is somewhat randomly or actually curated to be entertaining, not necessarily good long-term investment advice. News highlights short-term success, failures, who got it right. And nobody really follows up on the advice that you hear on CNBC or Bloomberg TV or the other financial networks. And they're not talking about long-term results either. So turn off the news. And then what about experts? I mean, there are a lot of experts that are quite valuable. And so understanding what experts' value is can be measured, of course, and we like to do that. I thought this was an interesting story. On the left here, we have a Wall Street Journal headline from November of 2022. Goldman Sachs, certainly one of the smartest group of economists, investors. It's a massive institution with 100 years of experience. And their experts said in November of 2022, don't expect a stock market rebound next year, Goldman Sachs says. In fact, they were pretty down on the stock market at that moment. Now, the next year, the stock market went up about 26%. The following year, also about 25%. And in fact, since this article, the stock market, as measured by the S&P 500 index, is up 87% or 23% per year, which is more than double the long-term performance of the stock market. So Goldman Sachs got that way off, not even close to right. And then, just last week, I got this alert on my phone, Goldman Sachs again, Morgan Stanley. They warn of a market correction. Things run and then they pull back. They're talking about a 20% correction. And Morgan Stanley's on board with that too. So, maybe they're right this time, but let's not use maybe. Let's have a process that is independent of short-term forecasts. So that's where the asset allocation is really powerful. Now, there are experts, and maybe you know this guy, Jim Cramer, Mad Money, CNBC. I love watching him. He's so enthusiastic. You got to love the slogan, watch TV, get rich. Who does not like that concept? Wouldn't that be nice if it was that easy? And in fact, Jim Cramer has a portfolio, the Action Alerts portfolio. He has thousands of subscribers that follow and track his portfolio of recommendations. And so I thought it would be useful, just as an example, because Jim Cramer is a highly respected newscaster, portfolio manager, analyst. He's got a big team of people supporting him, thousands of paid subscribers investing in his recommendations. So I thought it'd be valuable as an example to show his performance versus the S&P 500 index, which is kind of the benchmark for performance measurement for stock portfolios. Now, the S&P 500 is just the largest 500 companies in the United States, and so that's kind of a static portfolio. So, in fact, here, let me dive in here. Here's Jim's performance on the left and the S&P index, and you can see in the green when the S&P outperformed Jim Cramer's portfolio virtually every year, and that's disappointing because he spent so much time working on this. This index has beat him every year. In fact, if you look on the right, and I just went back to 2013, but in the right side here, you can see if you gave Jim Cramer $100, you'd have $348. That's pretty nice. But if you just put it in the index and did nothing, you'd have $553, which is 59% more. So that's meaningful. And in fact, if we look at that, percentage-wise, over this period, Jim Cramer is up 248%. Again, that's a nice rate of return, almost 10% per year. But the stock market over that same period went up 453% or 14% per year, which is almost 50% more. This is meaningfully different. And so not a good, watch him, but do not follow his investment strategies. He is struggling to even come close to the stock market. Now, that being said, there are some people in the world that are just viewed as just long-term geniuses when it comes to investing. This gentleman, Warren Buffett, is one of those guys. You know, he spent his whole life investing in companies, and Berkshire Hathaway is an iconic company, and Warren Buffett's made a fortune for himself and his clients. So I thought it'd be great, you know, when we have really the smartest, most sophisticated investors to look at their performance, you know, because, you know, they have special access to deals that the public never gets. They've got massive teams of researchers. They can take their money anywhere they want, any way they want. And so I thought it'd be helpful just to show, you know, Berkshire Hathaway's performance compared to the S&P 500. This chart, let me zoom in. I went back 10 years as an example. The purple line is the S&P 500 performance, and the orange line is the Berkshire Hathaway performance. And you can see, you know, they're kind of very similar. And if we look at after 10 years, the stock market is up 291%, and Berkshire Hathaway is up 252. That's kind of meaningfully different, and you can see here Berkshire Hathaway's averaged 13% per year, much better than Kramer, frankly. But again, not even as good as the stock market in general. So, you know, that's good to know how hard it is to outperform things. And you know, Berkshire Hathaway in total 252% in 10 years, 13% per year, great. But the stock market over that period, 291%, over 14.5% per year. And that's, again, what we would say 130 basis points. That is a big difference per year. So just FYI, be careful about that. Quickly want to talk about this negativity bias built into our brains. Basically, our brains have been wired for thousands of years to be more cautious about bad things. And in fact, you know, science has shown that the pain from a loss is about 2 times more painful than the pleasure we get from a comparable gain. And as we think about investing, that means when we lose money, boy, we really feel bad about that. And then when we make money, it just doesn't quite have the same feeling in our brain. And so we should just be aware that it's going to feel really bad when things go wrong, and it's not going to feel as great when things are going well. So let's focus on the data and not let our emotions get caught up in the process. Also remember, these investments go up and down. Most of the people have publicly traded securities for private foundations, which is appropriate, but they do move every day and sometimes unexpectedly. So just remember that market volatility is a normal part of the experience. And of course, we have a time horizon for most foundations that is decades, not days, not weeks, not years. So let's not get too caught up in the day-to-day, week-to-week, month-to-month volatility. Let's focus on our long-term asset allocation and have a good understanding of our long-term performance. So what is the solution? In my opinion, you know, we should all be building an institutional, battle-tested portfolio that will anticipate and react to market conditions over the long term. Now, the anticipate part is the asset allocation. We know different assets perform differently, so we're going to know that's happening, so we're going to build a portfolio of different asset classes and different investments. And then the reacting part is the rebalancing we're going to do to our portfolio when things move in different directions. So that's the easy answer. Not that easy to actually do this, but that's what we want to do. So let's go back to who's going to be driving the bus now, because we know who's on the bus. So we figured that out. And who's driving the bus comes down to the question of these 4 common investment management models. Before we jump into that, quickly though, you know, a few basic elements of a comprehensive process, just to reiterate what we talked about earlier. Who's going to be on the team? Who's going to write the IPS? What are the goals? how will the asset allocation be determined? Usually that's set by the board or the investment committee. Maybe you get advice from your manager, but the board or the investment committee sets that number, and then the managers manage within it. Who's going to do the reporting? How are we going to measure performance? How often are we going to meet? What about other operational activities, proxy voting, tax audits, shareholder litigation, capital calls if you have private equity investments, et cetera, et cetera. There's a lot going on for an institutionally managed portfolio. So there's 4 ways to tackle those challenges. And this is kind of defined by Exponent, frankly. The number 1, board does it all model. Number 2, investment manager model. Number 3, the investment consultant model. And finally, the professional chief investment officer model. Now, I'll tell you, Relevant falls into the 4th bucket. We are a professional chief investment officer. We believe this is a phenomenal partnership with our clients by bringing a comprehensive solution. So we'll get to that. But first, the board does it all model. Now, this is something that dates back 30, 40 years ago, where you had a board of people that were pretty savvy. They would invest some money, using research or information they had, and monitor their performance themselves. Now, this is okay if you have a sophisticated board with extensive investment expertise. It's simple and lean. It allows for the board to participate because they're doing it. And the fees might be less because you're not hiring professionals as much. Some of the challenges, though, you got to put a lot of time in. You're competing with professionals. You got to do the reporting, which is not easy to do. You can't do this on a spreadsheet or something like that. You're not going to get this on your brokerage statements. You are competing against experts, and then the boards change over time, and then you have some liability if things don't go right. You have a fiduciary duty to make sure you have an appropriate strategy, and if you're doing it yourself, you wouldn't want to find yourself trying to defend that. So I don't recommend this for anyone today. Now, decades ago, it was more common. What morphed into the next model is the investment manager model. Now, this model is where the boards realize, hey, we're not investment experts, so let's go hire 2 or 3 investment managers and put them to work, and then we'll track their performance, and that's certainly better, and that does take advantage of expertise. So that still requires a sophisticated board because they have to pick managers. Now, that's not easy. There's thousands of managers out there, and it's not easy to vet through that and understand which is the right manager for you. But it is simpler than some of the other processes. It allows for the board to participate. You might have some lower fees, and you're meeting your fiduciary duty here more by acknowledging you're not experts and you're going to work with experts. Now, some of the challenges, of course, you got to select these managers. I don't know, how you do that necessarily. The managers are siloed and kind of competing against each other, not working together. So you may have overlap in the portfolios that nobody can actually measure accurately, and so that might not be good. Boards do change over time, so then the legacy of why you pick the managers might disappear. And then tracking performance, tricky as I said. And then again, you're picking the managers, so maybe you pick the wrong managers and something doesn't work out. Now, of course, remember, when everything goes right, everyone's going to assume you got that right. When things go wrong, of course, people start pointing fingers. So this turned into the next iteration, which is the investment consultant model, where the boards realized we should just stay out of this altogether and hire consultants. And we'll get a consultant. They've got a bunch of managers. They vet it out. They'll spread out the money. They'll report back. This is a little more passive, or this is a lot more passive, actually. But it's a great way to go for some foundations that just really want to get out of the process and work with a consultant that does this exclusively. So this is great for smaller boards looking to outsource the process to an experienced expert. The consultant takes full charge of the process. They report back. There are some fees, but you usually get value for what you pay for, and you're definitely meeting your fiduciary duty. Now, you got to pick the consultant, of course. That's a little tricky, maybe. And then they're kind of off doing the work for you. So you got to have confidence in the consultant. It may limit your board engagement. Most consultants have a whole process that they have in place, and they want you to track that process. And they may have their own investment strategies or managers they're comfortable with, and then there's some other investment-related activities that maybe the consultant's not taking advantage of or not doing for you. So the most recent model, which is becoming more popular, is the professional chief investment officer model. This is a hybrid model where the board hires a firm that offers a full range of investment services tailored for your specific organization. So it's almost like having a team of people in your office as your chief investment officer team. But of course, most private foundations don't have the scale to have their own team. So they find a firm like Relevant or others that does this specifically for private foundations. The CIO also has a fiduciary duty, and they work directly with the board in a much more collaborative way. And the CIO usually leads the board to review and update the IPS. They schedule the meetings, the investment review meetings. We like to use Zoom for that, create the minutes. We provide, the CIO should provide a frequent reporting so you really are engaged in the process, understand the allocations, the performance, the benchmarking. So as a board or investment committee member, you really know what's happening almost in real time. Another thing that the CIO does is educate the board or the committee about what's going on in the investment community and the economy. This is really essential so that we all understand what the landscape looks like, because even though we may not want to change our asset allocation much, the investments within each asset class, we may want to tweak that based on what's happening in the world. So now the CIO also completes investment due diligence. This is really important, particularly with alternative strategies, which are more complicated. They manage the liquidity to make sure your foundation has the money they need for their grant making and taxes and anything else, paying their bills. They rebalance a portfolio within the limits, so they're doing that buy low, sell high rebalancing for you, and provide some back office services. Usually they're collecting your K-1s and 1099s and integrating with your other partners like your bookkeepers, your CPAs, your staff, and your committees. So it's a really, for me, a really enjoyable model because it's very engaging, and you work together as a team, and we know teams usually do better than individuals. So this is ideal for boards looking to outsource the process to an experienced and dedicated expert while remaining very engaged in the process. Some of the benefits: keeps the board closely engaged. All parties are fiduciaries who work as a team. The CIO has significant experience and resources, tools, and staff, so that you as an investment committee or board member can really devote your energy on the grant making while getting a lot of information from your committees so that you understand what's going on. This sort of hybrid model, I think, is super attractive. Now, this also provides continuity as boards change. So you've got a CIO team there representing your foundation. You get a new committee member on your investment committee or your board. Well, the CIO can get them up to speed, go through the investment policy, so that when they can participate equally. Some of the challenges, of course, you got to pick somebody or a company that you really feel aligned with. You got to have some connectivity, some chemistry there. It requires a little more time for the board than, say, a consultant model, which is more outsourced. But I think that's really important. I think understanding how the endowment is managed, you don't have to be an expert, but having a professional explain it to you in detail is great. How do you find the right one, of course? And, a chief investment officer provides a broader array of services, and they charge a little bit more money, typically. So let's segue for a minute and talk about fees, because, obviously we want to get what we pay for in life, and investment management fees are something that we really want to be careful about. So we did poll the group, what is the average investment management fee for the Exponent Philanthropy Foundations? It turns out, well, based on a recent survey, about 74 basis points, 0.74% per year. That's the fee that's assessed across the endowment value, typically every day over the course of the year. So 0.74% per year. So and that comes out of the performance, of course. And what your investment experts should be reporting performance that's net of all the fees in the strategies and their own fees, so you know exactly what the net fee is. But 74 basis points, I think it's always good to have some relativity as we think about fees and whatnot. And so I asked the audience, what do you think? How much does the stock market move every day, like just between the high and the low of the day, every day? So and we track this year relevant wealth because I think it's interesting. And looking at this year, the stock market has moved 1.2% per day, on average, between the high and the low just each day. So there's a massive amount of volatility every day in the U.S. equity portfolio, which is oftentimes the biggest asset class, considerably more than you're paying your manager for an entire year. So keep that in mind. A good manager should certainly deliver value well in excess of their fees. And knowing that this market in particular, is extremely volatile each day, that gives us some perspective. My recommendation as we kind of wind down here, pay for the best experts, choose investment products with competitive fees. Now, your investment manager or your CIOs obviously are going to want to have competitive fees for any investment that they invest in. Now, you might be hearing a buzzing because they're testing the alarms, I guess, this morning, so you can ignore that. So let's pause for a minute and talk about building a roadmap for long-term success. Something you can do with all this information. So I love, Warren Buffett. We talked about his performance. Still incredibly smart guy. And he has some really sage advice. In this quote, we don't have to be smarter than the rest. We have to be more disciplined than the rest. And that's a great message to realize. Just be disciplined, have a battle-tested process, stick to your allocations based on what works for your foundation. And over the long term, you should get the results you're expecting. Have a proven process. Now, I don't know about you, but have you ever flown in an airplane? Most of us flew to Columbus. And when you get on the plane, have you ever looked at the pilots and the co-pilots and just noticed how calm they are? They're about to get into this thing that weighs, hundreds of tons with hundreds of people in the back. Take a look at this cockpit. I mean, look at all the equipment there and switches and knobs and everything. And they're sitting there as calm as can be. And why do you think that is? Well, it's because they have a proven process. They've been trained. In fact, they have a checklist you can see here. The pilot on the right's got this checklist that they're going through. And so no matter what happens, pilots are trained to be calm and follow the process. And this is great advice as we think about investing. You have an emergency in an airplane. The pilots are always calm. Okay, let's tackle the problem, figure out, let's check our checklist. We've prepared for this. And so having a proven process for your investments is super important. And then sticking with it. That way, the markets are going to get volatile, and when you have a proven process and that happens, you just say, well, we understand that's going to happen, and our process will adapt. So when you think about your process, what concerns come to mind? Do you have a structured dynamic review process? Are you sure, what's driving the results? So, looking at the total performance is great, but how is each asset class doing? How are we going to select the best investments for managers? We want to monitor that process and make sure that we're doing well over time. Let me dive in here. Are there regulatory issues we should be worried about? Of course, when was the last time the IPS was updated? Comprehensive elements of an investment policy. Look at your IPS. Make sure it defines the philosophy, the objectives, the goals, the risk and time horizon, the asset allocation, all these things. All these things need to be part of your IPS. here's just a side note here. It's a great book I read by Dan Sullivan, Who Not How. Before you kind of dive into the deep end of doing this yourself, think about whether it's just better to hire experts. And, I love doing things myself at home and around the house, and usually, I'm a do-it-yourself kind of guy. Oftentimes, though, I've learned that hiring experts gives you better outcomes. It also frees up time and resources for me to do something else. And so if you're like me and you're kind of a do-it-yourself person, check out this book. It's on Amazon, Who Not How by Dan Sullivan. I thought it was a great read and provided some valuable perspective. Okay, so select an investment model. When you're considering those 4 models, of course, I don't like number 1, stay away from trying to do it yourself. The other 3, one of those might be right for your board. Look at each model has benefits and limitations. And you might change your model over years. You might start selecting managers and realize, well, you're having trouble doing that. You might work with a consultant and feel like, okay, that's great. Or you might decide, okay, we want to have a more engaged process with a direct team, a CIO team that's more aligned directly with us and kind of acts as our fiduciary partner. So those, think about those. And as we kind of wrap up some final thoughts, you can make this happen. Just remember, investment cycles, they happen. They're not easy to forecast. Bull and bear markets are common. Good news, of course, you may not know this, but bull markets are typically 3 times longer and bigger than bear markets. We know most investments perform over time and deliver attractive returns. And so the proper asset allocation is essential, so you don't create more risk in the portfolio than you're comfortable with. Remember, as you're looking at the investment models, you have a fiduciary duty to have an appropriate investment process. Pick a process that makes sense for you. Ask questions, and remember, teams perform better than individuals. It's fun to work with an exciting team, particularly somebody that's really brings a lot of value and education to the table so that you can feel really engaged and also confident in what's going on with your investments. And don't forget your 3 obligations, of course. You got to approve the investment policies. You got to employ appropriate asset management. You need to review your investment performance. Those are table stakes. You got to do that. And remember to set that asset allocation based on a survey or some expert advice. Rebalance, take advantage of the market volatility. Diversify within asset classes. Just remember, diversification is your friend here. We're trying to grow and protect your endowment. Your personal assets, you may be more aggressive, but remember, you are required by MIFA to diversify your portfolio. Turn off that financial news. We know it's entertaining. And don't time the markets and focus on your time horizon. Okay, a couple things I offer to the group, and if you're watching this video and you like a little feedback from the relevant team, we're happy to take a look at your investment policy statement, give that a confidential review. I will also offer a portfolio stress test. If you want us to take a look at your portfolio and dive into what you're doing and give you kind of our perspective on what looks good. Maybe there's some gaps that you might want to think about addressing. Feel free to take advantage of that. Just send me an email and we'll coordinate getting those documents and provide that review in short order. A couple other resources around investment policy statements. Now, Exponent has 2 resources on their website. There's a link here, how to create an IPS, super helpful. And they actually have a sample IPS here. If you want to have a template to work from, they have it here for free for the members, so that's great. A couple other things. I did write a book, Mission Possible, How to Achieve All Your Family Foundation's Goals. We had copies of that available. If you'd like a copy of that, just send me an email and provide your address. And Stanford has a really great guide. I just came across the Stanford Guide to Effective Philanthropy. This is a powerful tool for anybody that's just getting into philanthropy. Maybe it's your kids or somebody else you know, or maybe you just want a resource that just starts at the beginning of how to have a process of giving and the mindset. This guide is amazing. I can give it to you as a PDF for free. You can also buy it on the Stanford website. So if you'd like the Stanford Guide, email me. I'll send you that document and be happy to mail you the book. So that kind of wrapped up our presentation. It was well received. Hopefully you found some value in this. If you want the slides, please just send me an email, bruce@relevantwealth.com, or give me a call. Here's my contact information on the QR code if you want to have that in your database. So let me just close out by saying thank you. It's been great spending some time sharing my presentation. I know I went through that very quickly. And so if you have questions, call me. I love talking to Exponent members and working with foundations to help them really feel good about their investment process so that they can focus on their grant making and philanthropy. So have a wonderful day, and we will talk to you soon. Take care.